Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through in our economy show just kind of a broad backdrop of where are we in terms of positioning as we start the new year, where are we with vaccinations, what does that look like, and then some of the data behind it. Then we're going to go a little bit deeper into some of the leading indicators that have recently come out for the U.S. And then we're going to go do a deep dive again on what is happening with the U.S. consumer spending. How is that going to be implicated based on the new stimulus, less stimulus? And then obviously following up with Europe, what is going to happen with the renewed lockdowns? And then wrapping up with Asia with a look at some of the Chinese movements that we've seen over the last few weeks. So just kicking off, please like, share, subscribe. Your support is appreciated. I thought this was an interesting chart that just kind of shows you where we started off in 2020 and where we're starting off in 2021. So equities, U.S. focused, global, you could just see that we're very much levered to a very similar backdrop where, government debt is obviously lower, but aggregate bonds have kind of replaced that as we go into the end of into the new year with a huge equity focus, very specifically U.S. as well as sector specific, as we do have an increase in ETFs. But you can see that we're very much positioned for risk on. This is a risk on type structure, which, as anybody who's currently watching, things are happening and getting out of hand in Washington, D.C., and the market's up. And I'm not saying that there should be a direct correlation, but there are so many things that are just continuously ignored that's why when we look at the positioning and then as we go into what is the retail consumer, the retail investor doing, and what is going to happen on a continuous basis, this risk on we really haven't seen any big adjustment. People just keep getting longer and longer, even though the issues continue to rise. Now, when we talk about issues, we look at, let's look at vaccinations. This is going to look at the EU. So the EU has been fairly slow in terms of getting the vaccinations in the works. Now, they just went and approved Moderna. That will start to accelerate things. The U.S. is obviously, this is the amount of people that have been vaccinated so far in December. But there's, caveats within this because each inoculation takes 2 doses, and the doses have to be given very close to each other within after 2 weeks within a 3-day window. Now, because we're starting to run a little low on vaccinations, there is going to be a slowdown of first doses to make sure that the second dose is delivered. And the reason why is, there's belief that a first dose gives you a 50% chance of being vaccinated, and then the second dose gives you that 95% certainty. So the idea is getting to the 95%, not just trying to get everybody to 50%. So this is why we're going to start to see that slowdown, which is why on a logistics level, when we keep talking about it, it will take time to really get to where we need to be to hit that quote unquote herd immunity. And where that can really shake out is going to determine based on how quickly can we make it, how many of these are approved. Because in the U.S., I don't know if it's the same elsewhere, but in the U.S., if you get the Pfizer one, the second one has to be Pfizer. If you get the Moderna one, the second one has to be Moderna. You can't cross pollinate, which makes sense if you think about it. Just, you got one, you stick with one. But that's why even if people can get the first dose, it doesn't mean you can get your second dose, or they can continue to give first doses of one or the other. So this is something to watch. And then obviously Israel has been very aggressive in increasing their inoculations, which is obviously a positive. Now, when we look at vaccines across America, about 1.3% of the population has been vaccinated, and 33% of the shots distributed to states have been administered. And again, that's why when we look at the speed in which it's happened, which is where we're looking at some of the slowdowns, as we can kind of catch up with, the demand, and just using my mother as an example, who just received her first dose. She had to drive an hour and a half away in order to get the first dose, and then she's given a slip of paper that says, "This is the one that you got. This is when you have to be there, and this is the 3-day window." And, you don't have to go back to that same hospital, but you have to go to a hospital within the system. But they were talking about how there's concern about that second dosage, which will start to slow down how many vaccinations, complete vaccinations that will be accomplished in order to kind of get to that level. And then when we look at, the amount administered per million people, obviously Israel's at that high level. We need to see this start to accelerate at the US level, UK level, to start to hit some of these targets that we've been hearing about, which is June, July, August. And without an acceleration, we're going to just see some of this slowdown in terms of, when can we actually hit these numbers? Does that become now Q4, Q1 of 2022? And this will have a direct impact into how comfortable are people shopping, leaving the home, still staying in quarantine, what does that look like? And we need to see that acceleration in order to see a certain amount of comfort and economic growth that I think people are confident on in Q1. I'm a little less confident, obviously, with the after the Georgia election, with the Senate, now there's going to be the $2,000 stimulus check is going to come back to the floor. If that gets approved, what does that mean for growth within the U.S.? Obviously, Europe has their own stimulus, which is trying to push things forward. But with their own lockdowns, we're expecting another, that double dip recession with things slowing down again. It's just going to be a very slow grind. And as the advanced markets continue to struggle, it's just going to, that's going to bleed down into the emerging markets, which will just, if your biggest buyers aren't buying, it's really hard to kind of pick yourself up and get out of your, and see some growth. And that's why when we look at the percentage of adults in ICU beds, this is what we're talking about. When you have this amount of utilization, it's going to become very difficult because it's not cases. I mean, obviously cases matter, but infrastructure is going to dictate lockdowns. It's going to dictate, how concerned are people. And when you're in this kind of level, it's going to be very difficult to see people get to some sort of normalization because consumer behavior will naturally adjust with something like this actually transpiring. And this is why we keep talking about ICU beds and how much they're occupied. We're seeing things that are a little bit better than last time. People are obviously sick, they're going to the hospital, but the hospital stays are on average, the stay is shorter. It's still long for the average stay. It's about 8 to 12 days instead of 12 to 16. So it's 8 to 12 days. They're not requiring the same type of ICU care as previously. They're still requiring care, but so this is, even though it's stressing, it's not as taxing as before. And now that we understand the disease a bit more, the life cycle, the treatments, things won't, shouldn't get as bad, or things should be managed a little bit better. Obviously hoping they're managed better, but those are things that we're seeing, at least in the Northeast. I know personally in New York, and that's, but again, these are things that we have to watch because this is going to impact economic activity. What are people willing to do, and what will the governments react with on a lockdown level? Now, when we talk about inequalities and immobility, we keep talking about it, and one of some of the things that we've talked about are how any ism is a negative. Any ism is a problem. And when we think about social mobility, income inequality, but when you have very limited social mobility, again, we see the rise of an aggression. I mean, we're seeing it again on DC on the other side. We saw, in terms of Black Lives Matter, now we're seeing the Patriots or whatever they're calling themselves. Each side has reasons to be angry. It's just how are they expressing it? And that's when you start to come into, well, what is your social mobility? What is your ability to better yourself in society if you work hard? Can you get that promotion? Can you get a job that is befitting your education or what you're looking to do? Or do you feel trapped? Do you feel belittled? Do you see yourself as not participating in the advancement of what you expected? And that's where the social immobility is only increasing. And as it continues to increase, people will feel frustrated. They will feel, left behind. And that's when you start to see an uprising on all sides. And that's something that we have to consider when we look at income inequality, because as that increases, people were like, well, how can I achieve that? But then when I look at the mobility, my inability to achieve it, even though I'm trying everything I can, like I know myself, it's hard to stay motivated when it's like, well, why am I doing this? Like right now, this isn't generating much. When is that going to turn around? And that's when, you continue to say, well, we're going to try harder. We're going to try something different. But when you get disenfranchised, that's when you start to see, you can see the pivot, because when you're disenfranchised, you're going to search out a mentor. You're going to search out someone who is giving you answers, and it may be the wrong answer. They may take advantage of you. I mean, this is, cults prey on people who not really have soft minds, but people who are susceptible to manipulation because they're trying to seek an answer for where they are in life. And that's where these isms come in, and people try to latch onto the extremes, and they do stupid things. And that's why we have to, recognize this and address the issue at hand, which is, why do we have social immobility? What has created this? Is it the monopolies that have been created? Is it the Fed printing that has created a lopsided income inequality? There are a lot of things that we can address that we all know as a populace, in terms of starting the common sense party, which I'd love to be ahead of, because it's like, well, we know the issue, but everyone keeps hiding it because it's not politically attainable. It's not something that's politically pushed for, because it means that you'd have to give up. You do things that may not get you reelected again, because you're going to do things that aren't going to be popular, but they're the right thing to do for the long term. Again, Volcker, said I'm going to put you into a mild depression, because I shouldn't say depression, recession, in order to fix the inflation problem. And he did, and he got death threats because of it. But at the end of the day, he did the right thing at the right time for the sake of the economy overall, and then set us up for the 90s, which saw a lot of growth, a lot of investment, a lot of new technology, a new industry was born. And there's a lot of these issues of issuing stock, buying back stock, and when you're issuing debt. So you're leveraging your balance sheet, you're creating nothing, you're leveraging your balance sheet, and you're buying stock. Who's benefiting from buying stock? Not the 90% of people that don't own your stock or own stock in general. So again, that's where we start to see this. But again, if you took that money and invented something, R&D, built a facility, built a new assembly line, did something, like that's jobs. That's delivering something tangible that would provide, you need managers, you need workers, you need janitors. Then they feel better because they have more money. So now the restaurants open up, and again, you get that trickle down through the area. And this is, I think, a very important chart that I'll keep coming back to, because this is the crux of where we sit on a global level. This isn't just a U.S. thing. This is a global problem as we see the extremes increasing, as social mobility is depressed and continues to get depressed, which is causing this, where people are trying to essentially channel their anger. And this is a huge problem right now. And I have my answers. I think, that we've had lots of discussions on this, but again, this is something to watch. Now, again, when you think about, well, what are they trying to do? Well, let's look at government debt. When we look at government debt, you can see developed market debt continues to rise, where emerging market debt is rising, not saying it isn't, but is obviously on a different slope. But then when we look at government interest payments, Germany's at negative, Greece is at zero, Portugal's at zero, U.S. is at just over 1%. In terms of what their interest payments are. But EM interest payments, obviously that's riskier and people are looking to go down that curve, but interest payments increasing is going to be a bigger problem, especially if we have a slow recovery in GDP, because that means trade will be slower, demand in developed markets will be slower. So emerging markets won't get dollars, they won't get trade, and the interest payments or an interest in general in terms of the expense will limit growth, will hit in terms of how quickly can the economy recover, how costly will it be, and that's, again, pulling forward growth because you're going to have to pay off your debt. And this is why we continue to be so concerned about debt in general, because it is a huge overhang as long as you're continuing to pay interest payments. Now, could you stop? Sure, you can default. But again, these are key problems that we continue to address, because government debt is increasing, but so are interest payments. And now government debt, and I'll look at the U.S. to show how, look, debt is increasing exponentially. And even though interest rates have come down, we still have a rising interest expense because we're borrowing so much. So we're really not inflating away. We're inflating away but not fast enough. And we're borrowing so much that even though we're trying to inflate it away, we're adding more of principal, which is adding more to the interest expense. So it's kind of flatlined to increasing. Again, inherent problems overall. And this is looking at global debt across the world. So this is, again, world level. Then you have the advanced economies, and here you can see emerging markets. Everything is shifting up, but obviously the slope of emerging markets and essentially how much is much less than the advanced economies. Again, going to become the bigger issue over time, especially with how quickly can we get the vaccine rollout? How quickly can we get things adjusted? And this is looking at baseline and downside on higher case loads, slower vaccine, and there's still expected to be growth because it's year over year. And when we think about how bad 2020 was, comps are easier, but global growth is still going to struggle, and especially in advanced economies. I think now, do I think baseline is too high? Yes. Based on what we're seeing, what's happening right now, yes. There is a concern that it is too high. Is the downside too low? Most likely. And again, these are estimates. We're using what we can based on the information that we have. And when we look at things, over time, this I think is going to trend lower, and it's going to put pressure on not only 2021 but also 2022, just in terms of how quickly we can get this recovery. And that's why when we look at dollars, so even though we have all of these issues, we have the expectations of a new stimulus bill hitting the Senate floor, the dollar continues to come under pressure, because the idea is that dollar is going to go down, gold will go up. But right now in this market, that's reversed. Right now, dollar's flat and gold is down $40. And the question is going to be, how much do we get this adjustment? Because dollar is going down. The USD going down has been beneficial for all risk assets. So dollar going down means just buy everything. But now with dollar flat to up, people are still buying. So at what point do we get this snapback, especially because the short position in the dollar is so high, coming back closer to 2007, 2008 levels? Is it a crowded trade? Does that create a snapback? What is the European Union? What does the ECB do about a strong euro? Do they try to address that by weakening it? But the dollar continues to be under pressure, continues to see its fall. And even though some things have increased, again, it's just because the dollar has fallen so much. But with so much emerging market debt denominated in dollars, it also makes it easier for them to pay it back, as long as their currency doesn't depreciate as well, equal to or more than the dollar. So again, there's a lot of ifs, ands, buts in that, and we're seeing additional weakness in emerging markets. So even though the dollar is weakening, so is their currency and then some, which is offsetting some of the benefits that you would see from a weaker dollar. And then when we look at central bank balance sheets, this is just highlighting, from the G4 perspective of Fed, ECB, BOE, BOJ, just how aggressive that we're entering the new year with, at clearly over trillions upon trillions of dollars, and then the monthly change that we're going to continue to see of let's call it about 500 billion USD as we've converted it. And this is something to watch as we have additional balance sheet, because even though the balance sheet is expanding, it's not getting to the people who need it, or and again, this is the Cantillon effect. This is how do we get money, because it's sitting at the Fed, because yes, the banks are selling their treasuries, they're selling their mortgage-backed securities, and then they're just leaving those dollars at the Fed. They're not actually moving through the system. So yes, liquidity is out there. Yes, there's liquidity in this tight channel, and it's going to be hard to figure out a way to adjust that as we start going through Why are some of these banks not lending? And what does it mean when we look at debt and leverage on the consumer level? And then that looks at, world technology equity market capitalization. And here you can see the dot-com bubble and the share of total global market cap, and then the actual, and up to the moon. And again, even today, we're continuing to see this grind higher, this push higher, even though we remain at very elevated levels. And now when we look at EM economic recovery, the idea is that it will outpace. And this is just looking at it a little differently in terms of kind of that drop down and then the bounce back. Again, we continue to be concerned on what 2021 looks like, especially with lockdowns getting extended through January. What does February look like? Emerging markets, now we have crude prices going up. Crude prices going up means gasoline prices will go up, diesel prices will go up. That will increase inflation. That will increase costs for people as PPI is going to surge, as we'll talk about with what prices have been taken in terms of when we look at ISM, PMI, and what does that mean? And then when we look at, let's look at what's happening in the U.S. right now. So proposed stimulus payment boost to $2,000. There's obviously going to be a bigger boost versus the $900 billion. But you can see that Bloomberg Economics has done a good job of putting this. There used to be a much wider spread of what $2,000 would do versus $600, $900. And you can see that starting to tighten because we're not seeing job recovery. We're seeing some, obviously not to the levels that were desired. And this is going to be a bigger hindrance to how quickly can we get this move up, especially as COVID cases get worse, people do less. Now what? Well, are people going to put it into savings, or are they going to turn it into and go purchase something? And right now, we've seen it go into savings and then immediately come out of savings because the people who are getting the money are the ones that are living closer and closer to paycheck by paycheck. So as it goes away, it's a shot in the arm, and then it quickly dwindles. And we have a good chart that we've talked about in previous econ shows, but we're going to re-highlight here to talk about what that means. And then this is just looking at the range of the recessions and what does this mean overall. And this is, again, looking at Bloomberg economic estimates, where we're coming back into this level, and now we're back into where we were when we started the recession. Personal income has fallen. Unfortunately, it's gotten worse because even though it's inflation adjusted, inflation is much higher than what is being quoted in the market. So inflation has gotten worse. Wages remain depressed, and or if they are any. So again, that's why it's going to provide much less on a personal income uplift. And we saw the first time, and again, law of diminishing returns. Now you have people that have not only eaten into, don't have a job, but they've started to eat into savings that wasn't from the government. So now anything you give them is going to replace what they've already spent. And so the $2,000 isn't a full $2,000. Maybe that recovers, puts another $500 that they spent, and puts $1,500 in the bank additional. These are things that we have to think about when we're considering how quickly will we get the turnaround, how quickly will things get better if we, and so far, continue to have a slow rollout of the vaccine, a very tumultuous time when we look at bankruptcies, hours worked, and just what the job market looks like, which is very concerning as we head into the new year, and as well as when we start talking about what is the next section, which is those leading indicators and what does it mean for Q1.